Hey, Rick.
Hey Sharon, how you doing?
Good, good. Talk to me today about um, pre-approvals. I constantly am telling my clients, let's get your pre-approval done. Let's and just expressing some of the power behind it. But I'd like you to tell us from the lender's perspective, from the mortgage broker's perspective, what a pre-approval is, what it is not.
Okay. Well, a pre-approval is basically going to hold the rate for the client for usually 120 days.
Mhm.
Now, there's a caveat. You have to be closing within 120 days from the date you get the pre-approval.
Right.
Uh, but what it is not is it gives so it tells you how much mortgage you can qualify for, and I will review all the client's paperwork and so forth to make sure that they're not basing their income on things that don't necessarily qualify as income. So, for
Right.
example, a client maybe has worked at a place for 6 months and they get bonuses or commissions and things like that, which is great. But if we're going to use that, we need a 2 year average. So if they've only worked there for 6 months, then we can't use that income that they get from commissions and or bonuses, right? So that's why it's very important that I check over all the documentations to catch any problems that might arise with people over declaring their income in that
Mhm.
example. That's one of the big problems with like the 5 minute online
Yeah.
pre-approvals you can get from the bank is, people are like, oh yeah, I make like 100 grand a year. Meanwhile, their qualified income is 40, right? So obviously when they go to the bank's going to say, oh, sorry, you don't actually get this mortgage. Uh,
Exactly.
but yeah, so it's very valuable because it lets you know how much mortgage you can be approved for, and it holds the rate, which is especially important in this raising rate environment because by holding the rate, it also guarantees your ability to qualify for that mortgage. Whereas, if rates go up again next month, then maybe you no longer you will no longer qualify for as much as you did this month. So it's good for that. What it does not do is guarantee that you will be able to get the mortgage for the property that you want to buy, because that property has not been pre-approved. You have, but your property has not.
Right.
So uh, there's a very good chance that the lender will require an appraisal. And if that appraisal comes in low, so let's say, you buy a property for 750,000 and it comes back that the property is really only worth 650 as far as the appraisal is concerned, then that is all the lender will lend on is 650. So that means you have to come up with that extra 100,000 on your own. So
Right.
that's why it is, and I know you're very good with this, Sharon. That's why it's so important to ensure that there is a condition of finance embedded in the offer, because even with a pre-approval, so you can get financing, but that house, the bank might not, or the lender might not like that house because the appraisal doesn't come in high enough, or maybe if it's not an A lender, like if it's not an insured deal, then the lender might not like the neighborhood or something like that. I've come across that before, where the
Right.
lender simply was like, "No, I'm sorry, we don't want to lend in that neighborhood. We don't."
Right.
Because if it's not insured, then it's the lender that's on the hook if it ends up going power of sale or something like that. So